You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Okay, let's dive in. This week, we've pulled together a pretty focused stack of sources covering global markets.
Yeah, we're looking at foreign exchange, commodities, some critical new trade policy stuff, and, those geopolitical undercurrents that are always simmering.
Exactly. And our mission today, for you listening, is really laser-focused. We want to extract the critical knowledge hinges for the week ahead.
Moving beyond just the headlines, right? To understand the mechanism driving things.
Precisely. How these markets actually move.
Look, if there's only one thing you take away from this whole deep dive, it really has to be this. The single most important variable this week is the U.S. labor picture.
Culminating in Friday's non-farm payrolls report.
Absolutely. Everything else, currencies, bond yields, energy, it's all taking its cue from what the Fed might do. And the Fed, they're waiting on labor data.
So the whole global narrative kind of hangs on this.
It really does hinge on this data series this week.
Okay, that sets the stage perfectly. So let's unpack the U.S. dollar first, because, while the greenback is definitely looking strong on the front foot.
Yeah, it is.
Our research points to, a classic mix of factors supporting this dollar strength. First, you've got pretty cautious Fed communication.
Right. Policymakers, they've sort of signaled they're open to cuts, sure, but maybe not as quickly as the market got ahead of itself thinking.
Not nearly as quickly as priced in before. And then you add the upside revision to Q2 growth figures,
showing that underlying economic resilience is still there.
Mm-hmm. And finally, inflation. It just remains.
Yep.
Well, what analysts are calling still sticky.
Yeah, it's proving harder to shake. And this combination, especially with traders having to adjust those, let's say, overly aggressive bets on rate cuts, it really favors dollar strength.
So when we talk about the dollar being on the front foot, a lot of that strength comes from something you flagged earlier, short covering.
Exactly. Let's quickly break that down.
Yeah, maybe define that quickly for the listener. What's short covering here?
Okay, so simply put, it means traders who had previously bet against the dollar, maybe assuming the Fed would cut rates much faster, they're now realizing, maybe that was the wrong call.
So they have to buy back.
They're forced to buy the dollar back to
Right.
close out those losing positions. And that buying pressure, it just adds fuel to the fire,
Yeah.
amplifying the dollar's move higher.
Got it. Okay, so here's where it gets really interesting then. All the attention pivots squarely to the U.S. labor data run-up this week.
Right. We've got the Joel test job openings,
ISM manufacturing employment number.
ADP private payrolls, the usual weekly claims.
It's a whole slew of data points just setting the table for the main event on Friday. So what should you be watching for in these sort of precursor reports?
Well, these reports basically shape expectations for Friday. The Fed's been really clear. Employment stability is the hinge for their policy decisions right now.
Okay.
So the consensus currently looks for a fairly modest payroll gain, unemployment holding steady, maybe average hourly earnings ticking up slightly on the month.
And the key takeaway?
The critical thing is this. A stronger than expected print, any of these leading indicators hinting at strength, would likely just reinforce the dollar's rebound.
Because it challenges that market pricing for rate cuts.
Immediately.
Yeah.
It pushes back against any remaining dovish hopes for the Fed's path.
Okay, so if the dollar's already pretty resilient, how weak does Friday's actual jobs number need to be to genuinely knock it down?
That's the thing. It sets a really high bar for dollar weakness now. You'd need, honestly, an unusually weak report.
Like a shock.
Yeah, a real shocker. Think negative job growth coupled with a surprisingly higher unemployment rate. Something like that might meaningfully undercut the greenback's momentum.
Anything less just confirms the Fed's caution.
Pretty much. It keeps them in that holding pattern.
Okay, let's turn to the rest of the G10 currencies then. USD JPY, the dollar-yen pair, still seems hypersensitive to those US-Japan rate differentials.
Correct. And we saw softer inflation data come out of Tokyo recently. Combine that with the resilient dollar story we just discussed.
And the pair climbs higher.
Yeah, it's testing that psychologically important 150 area again. And that level matters because, it brings the possibility, the threat of Bank of Japan intervention back into focus.
Right. They don't like it getting too weak too fast.
It's really a pure interest rate differential play at the moment.
Meanwhile, EUR-USD, the euro-dollar, it still feels like primarily a dollar story, right? Even though the ECB's recent survey showed European households actually have higher inflation expectations, both 1 year and 5 year out.
That's right, but it doesn't seem to be moving the euro much.
Why not? Why isn't that higher European inflation expectation boosting the euro?
Well, because the ECB has been very, very clear.
Mm-hmm.
They're still quite far from tightening policy again. So those expectations are, well, interesting. But the market sees the Fed's timeline as much more immediate, much more influential than the ECB's right now.
Okay, that makes sense.
And similarly, sterling is trading cautiously. Markets are watching the UK's latest softer PMI data, those manufacturing and service readings, and ongoing fiscal perceptions there. It's generally a risk-averse mood outside the dollar bloc.
Got it. And quickly over in Asia, we saw the People's Bank of China, the PBoC, deliver a firmer than expected fix on the yuan.
Which signals, their steady, controlling hand. They don't want it weakening too quickly either.
Right. And the Aussie and Kiwi dollars, kind of subdued.
Yeah, pretty subdued. Markets are weighing Australia's latest inflation pulse against some cautious guidance from the Reserve Bank of Australia, the RBA.
So it really feels like a waiting game everywhere else.
Absolutely. Dictated largely by what happens in Washington and New York with that jobs data.
Okay, so while the Fed and jobs data dictate the short-term rates and FX moves, there's a really big structural change happening this week from policy. And I mean the heavy hand of new U.S. trade tariffs.
This is huge.
These seem set to fundamentally reshape price dynamics, FX sensitivities, really impacting supply chains. These are new measures effective October 1st.
Yeah, this is where you really see Washington using tariffs not just as, say, a negotiating tactic, but as actual industrial policy to reshape industries.
And the White House announced a pretty specific and impactful list.
Very specific. And listen to how targeted these are. You've got a 100% tariff on branded or patented pharmaceuticals.
100%. Unless
production is cited domestically in the U.S.
Wow. Okay, 100%. That's not a nudge. That's a wall. What's the immediate insight there? Is this going to risk raising, say, Q4 inflation for essential items like medicines?
Oh, absolutely. That's a real risk.
Yeah.
The goal seems clear. Force critical production back on shore and do it immediately.
Which could drive regulatory arbitrage maybe for some firms?
Potentially. But yes, for any company that cannot immediately shift production, this is a massive input cost hitting a key consumer sector.
Yeah.
It almost certainly places upward pressure on prices for those specific goods locally.
And it's not just big pharma, is it? We're also seeing a 50% tariff on kitchen cabinets and bathroom vanities.
Things that go into housing, renovation.
A 30% tariff on upholstered furniture.
Again, consumer goods.
And a 25% tariff on heavy trucks made outside the U.S. That impacts logistics, transport.
That's the key link, right? This goes straight into the consumer economy and the industrial supply chain. This isn't just theory. These tariffs hit October 1st. Companies have to scramble or immediately pass those costs on.
And looking longer term, Washington is also weighing a strategic industry plan focused on semiconductors, reducing reliance on overseas chips.
Yeah, the idea apparently is to time market access, selling chips in the U.S., to a 1-to-1 domestic versus foreign production ratio.
1-to-1, what does that mean?
It means for every chip a company produces overseas and wants to sell in the U.S., they need to produce one chip in the U.S.
Wow. And there's a tariff backstop.
Apparently, yes. A tariff penalty for firms that fall short of that ratio.
This is, a fascinating insight into strategic policymaking. Why the 1-to-1?
Washington seems to be essentially forcing high-cost domestic capacity build-out. To keep their share in the critical U.S. market, international chip firms must invest equally on U.S. soil.
It's a powerful, non-monetary way to manage supply chain risk.
And encourage long-term capital investment domestically. Exactly.
And this strategic policy thinking, it's already causing ripples globally, isn't it? On the U.S.-China front, we saw that executive order signed regarding TikTok.
Right, with American investors slated to control the algorithm, supposedly. Though a potential presidential trip to Beijing still seems contingent on, continued cooperation on trade and other issues.
Still delicate there.
Right.
And we're seeing allies position themselves, too. Japan, for instance, stated publicly that any semiconductor and pharma tariffs applied to Japanese goods shouldn't exceed those faced by others.
Basically drawing a red line on fairness, saying, treat us equitably.
And Japan's finance ministry also announced a new facility at JBIC, linked to a Japan-U.S. investment package. Maybe quickly explain for the listener, what's JBIC and why is this facility notable?
Sure. JBIC is the Japan Bank for International Cooperation. It's essentially Japan's official export credit and development bank.
Okay.
The fact that they're linking a new investment facility specifically to a U.S. package, it really highlights how closely allied capital flow is becoming intertwined, even while they're negotiating friction over these tariffs.
So it shows deeper cooperation beneath the trade headlines.
Deep, structured economic cooperation, yes.
And we're seeing other moves too. Smaller but notable, like Ankara, Turkey, reportedly discussing tariff revisions and trade facilitation with Washington.
Which just indicates that this kind of trade policy negotiation is happening across the board, not just between the U.S. and China.
Okay, let's pivot then. Let's talk commodities. We spent the first half really focused on the Fed's labor signal, but what are commodities telling us about sort of real demand right now? Are they just waiting on NFP too?
Yeah, our sources suggest they're mostly starting the week in a holding pattern, which kind of confirms that wait-and-see mentality. Crude oil is actually slightly softer.
Balancing those constant geopolitical risks, Europe, Middle East against the U.S. demand picture, which ties back to the jobs data again.
Exactly. And oil logistics are definitely a focus area. Iraq is reportedly in talks with VHAL, the big trading house, to handle crude sales.
Tied to a potential restart of that Kurdish pipeline.
Potentially, yes. Any movement there signals a return of supply to the market, which could temper some of the recent price gains we've seen in oil.
Okay, but wait a second. Let's talk gold. If the dollar is strong and rate expectations are, cautious, staying higher for longer, doesn't that usually work against gold?
Classically, yes. A strong dollar and higher real rates usually make non-yielding gold less attractive.
But gold is consolidating just below its recent highs. It's holding up despite the firmer dollar. What's going on there?
That's probably the most fascinating anomaly in the commodity space this week. Gold defying a strong dollar like this, it signals pretty persistent haven demand.
So buyers are looking for safety.
It seems so. These buyers might be positioning for, broader uncertainty. Maybe it's geopolitical insurance, or perhaps they're betting the Fed ultimately misreads the labor data and has to pivot more dovish later on.
So it's like an insurance policy being bought right now.
That's a good way to put it.
Okay. And we also had two significant specific supply shocks last week hitting industrial materials. Copper eased off a bit after a disruption at Indonesia's big Freeport Grasberg mine.
Yeah, Grasberg accounts for a really material slice of global copper output. And Indonesia's mining ministry reported that production still hasn't fully resumed following that earlier disruption.
And that supply tightness immediately impacts prices.
And signals fragility in the global supply chain for critical metals like copper.
Then you had an energy shock over in Europe. France's power sector strike prompted force majeure declarations at 3 LNG terminals.
That's right, which temporarily blocked ships from unloading liquefied natural gas.
These specific localized shocks really show how quickly events can impact globally traded inputs.
Especially something like natural gas futures in Europe, which are very sensitive to these terminal operations.
Okay, let's quickly touch on central banks outside the U.S. then. They provide necessary context, but probably aren't the main drivers this week.
Unlikely to be hard catalysts? No. The Reserve Bank of Australia is meeting, but markets are strongly expecting them to stay on hold.
So the focus there is just on the statement.
Entirely on the tone of their guidance, particularly regarding the labor market and what they see ahead of their late October CPI inflation print. They're just waiting for more clarity, like everyone else.
Okay. And similarly, in the Eurozone, preliminary inflation data is expected, maybe showing a temporary drift above target.
Yeah, probably due to volatile components like energy again.
Yeah.
But overall market pricing still sees the ECB holding steady in the near term. They're unlikely to be swayed by transient inflation figures right now.
They've signaled that pretty clearly.
Very clearly. And in Japan, you'll get the Bank of Japan's Summary of Opinions, the Tankan Business Survey. That'll inform the domestic picture for the yen.
But ultimately interpreted through that U.S. rates lens.
Absolutely. It all comes back to the U.S.-Japan rate spread. If the American data surprises strong, the yen probably weakens further. If it surprises weak, some pressure might ease off the BOJ.
Right. Okay, now for that undercurrent we mentioned, the one that affects both FX risk premia and commodity prices.
Yeah.
Geopolitics. What's bubbling up there?
Well, in Europe, officials reportedly privately warned Moscow they are prepared to shoot down aircraft after a recent airspace incursion near Estonia.
And France offered support to Denmark, too.
Yeah, following those drone sightings that disrupted airports there recently, it just highlights ongoing tensions.
What's the market implication of this increased security tension in Europe? Does it register?
It subtly increases the risk premium priced into the euro and European assets. You might see European government bond spreads widen slightly, just reflecting a higher perceived regional risk, even if it's low probability.
Okay. And security concerns remain high in Ukraine, obviously. The IAEA reported a drone detonating quite close, about 800 meters, from the South Ukraine nuclear plant perimeter.
Which just confirms that ongoing risk of instability impacting really critical infrastructure there.
And shifting to the Middle East, kind of mixed signals. U.S. officials describe productive talks on Gaza. Maybe a hostage agreement could be near.
Which would be seen as a de-escalatory signal, potentially positive for risk sentiment if it happens.
However, Washington is also reiterating they will not support any annexation of the West Bank.
Maintaining that diplomatic line. But on the other side, maybe more concerning from a long-term view, Tehran and Moscow announced a plan for 4 new nuclear power plants to be built in Iran.
With Russian help.
With Russian help. And their cooperation with the IAEA, the nuclear watchdog, apparently hinges on the absence of, quote, hostile action.
What are the implications there?
Well, this is a significant long-term geopolitical and energy policy move. It strengthens that Russia-Iran axis. It could have implications down the road for global oil supply stability, insurance costs for shipping in the Gulf. The market watches these developments closely for how the IAEA and Western powers respond.
Okay. And finally, over in Asia, South Korea fired warning shots at a North Korean commercial vessel.
Because it crossed the maritime border.
Yeah.
It's another reminder of that constant security risk on the peninsula, which can sometimes trigger small, temporary safety bids for currencies like the yen or even the dollar.
Right, keeps things on edge.
Yeah.
Okay, so let's try to synthesize this whole deep dive then.
Okay. I mean, it feels like the entire week is really structured around that UX labor data. The base case scenario, maybe cooling without collapse in the jobs market.
Means the dollar probably stays resilient.
Dollar resilience likely persists, yeah. And non-U.S. central banks probably stick to their familiar, cautious scripts. Risk assets likely remain somewhat range-bound until we get that clarity on Friday.
So the essential takeaway for you, the listener, is really understanding that relationship between the activity data, the labor market growth, and the policy caution coming from the Fed.
That specific dynamic, that's the key driver of short-term market resilience right now. Don't get too caught up in the small data points before Friday. Focus on that ultimate NFP outcome.
Right. But stepping back, maybe a final thought here, we have to consider the longer-term impact of these non-monetary actions we discussed.
Yeah, things like those tariffs.
When you see 100% tariffs slapped on essential goods like branded pharmaceuticals, new tariffs on heavy trucks, combined with major geopolitical shifts like that Iran and Moscow plan for 4 new nuclear power plants.
You have to ask, right? What trajectory do these big geopolitical and trade decisions actually place global inflation and long-term supply chain stability on, especially as we move into a new quarter, a new month?
That's the risk that kind of lingers, doesn't it? Long after Friday's NFP dust settles. Something for you to think about.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.